Well, good afternoon and welcome to our HighRock Weekly Client Webinar. If you want to skip over our standard introduction or any other part of this webcast, feel free to use the fast forward control on your screen. If you are listening to the recorded version, I can't fast forward if I'm live. Otherwise, please sit back and enjoy. Each week on this call, we talk about what we see developing in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you likely know, if you are a regular listener, we invest our money in the exact same models as our clients. This is a very significant and defines why our prudent and disciplined investing strategy binds us with you. All of our investing interests are aligned. Our discretionary portfolio management not only ensures our legal fiduciary responsibility to you, but also enables us to make quick decisions and execute them immediately for all of us simultaneously. In tricky and volatile markets, this is crucial as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson, and joining us on the call today is my partner and colleague, Paul Tepsich, the founder of HighRock. Our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson, has taken a short leave following the birth of her first child, a strapping young, now 12-pound boy named Mason. She does remain on call to us for her expert advice, should we need it on your behalf. Each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we do have a separate introductory webinar that will provide you with this. And all you need to do is visit the homepage of our website and click on the Introduction to HighRock Private Client button. While you're at it, you may be interested in our voluntary code of conduct as well, something that takes us well above the regulatory requirements in many ways and highlights how we always put our clients' interests before our own. Well, now that we've reached the halfway point for the year, a review of our themes for 2017, our strategy of taking a more tactical approach to investing remains optimal because of the even greater levels of uncertainty and higher levels of risk imposed on financial markets by a plethora of evolving factors. Price stability is a mandate for all central banks, and the level of inflation or expected inflation is a key determinant for central bank policy. While current data show inflation below most central bank targets, the Bank of Canada, the Bank of England, and the European Central Bank have dropped hints that they are reviewing the easier monetary policy situation and ready to start reversing it. Now, the U.S. Federal Reserve has raised rates by 0.75% since December, and it is expected that they may raise them 2 more times this year. Now, rising borrowing costs and reduced financial system liquidity, which had been driving equity and housing markets higher, may increase volatility going forward. Stock prices and valuations are close to their highs, but without more significant earnings growth, this leaves them vulnerable to correction. Risk in the stock market is very high. And while we wait on the Trump agenda, Brexit negotiations and NAFTA renegotiation, tensions with North Korea, Russia, and the Middle East, as well as global cyber attacks and terrorist threats, all add to the blend of geopolitical uncertainty that we are facing. Well, historically, strong economic growth will tend to push stock market prices up and bond prices fall as interest rates move higher. When economic growth stalls, stock prices fall and bond prices rise, and this correlation is the rationale behind a balanced portfolio. However, these correlations are currently in a bit of a state of flux as markets try to determine what will happen next amid all of the uncertainty, and the correlations are not providing the same level of protections, both in the U.S. and in Canada. And just look at how bond yields have jumped while stock prices have fallen. So both stock prices falling and bond prices falling is not what we would consider the normal correlation here. Having a more tactical approach to investing allows us to not have to depend on the less reliable old correlations, which do not appear to be providing the appropriate balance anymore. When we look for investing opportunity, we are patient and buy assets for our portfolios only when we see value in owning them. And it may be a reason why newer clients might still have more cash equivalent assets on hand, because building a solid portfolio takes time. No need to rush in and buy expensive assets if they are going to get cheaper. Well, our benchmark equity index, which we use for comparison purposes, is made up of over 50% U.S. equities. And so by comparison, we use a number of equity ETFs to get global equity market exposure in our global equity model. We use the Vanguard S&P 500 Equity Index ETF, which has turned lower recently, but has been outperforming the benchmark for the last couple of years. Now, at recent highs, we have been holding off on any new purchases. We also use the Russell 2000 Index ETF for more U.S. market exposure in the smaller companies situations, which has basically matched the benchmark returns over the last couple of years. For our Canadian large cap exposure, we use the BMO S&P TSX Index ETF, which has actually been an underperformer. For non-North American equities, use the Vanguard FTSE Developed All Cap ex-US Index ETF, but it has also underperformed the benchmark. And for emerging market equities, we use the Vanguard FTSE Emerging Markets All Cap Index ETF, which also has underperformed the All Country World Index benchmark. So we do adjust the weightings that we assign to the various ETFs that we include in our equity model to be tactical based on our macroeconomic research and value metrics. At the moment, we see plenty of risk, especially in the U.S. equity market, and therefore carrying a lower than normal weight of U.S. equity. So that is a brief glimpse at some of the areas that we consider for our global equity model relative to the benchmark All Country World Index. We take the allocation of the benchmark All Country World Index All Country World Equity Index ETF and blend it with the Canadian Bond Index ETF to get a weighted return for comparison purposes. Now, these are the results for the end of the second quarter of 2017. You may note that while the one-year blended benchmark net of fees has returned about 10%, the two-year annualized return has only returned about 4.25%, and that highlights the volatility over the last couple of years. Now, even the average annual return over the last 3 years is well below the 5-year annual average return. And as you know, I repeat regularly on this call, our focus is on reducing volatility in our portfolios in the short term in order to avoid big swings in return and be able to capture more consistent long-term returns. Now, as we look at a longer-term HIROC Private Client, the one-year total performance after fees is about 7.25%. Now, that's definitely behind the benchmark at this moment, but currently with about 25% in a money market fund, this portfolio is significantly less exposed to expensive, risky assets like U.S. equities, which we believe are vulnerable to at least a 10% correction. So focusing on the longer term, 4.5-year performance, this portfolio remains well ahead of the benchmark. It shows how little of an impact the 1, 2, and 3-year periods have actually had on the longer-term performance, a sign that we have been successful in lowering short-term volatility, which does in fact enhance longer-term returns. Well, at HIROC, we focus on the difference between the absolute returns and the risk-adjusted returns. The actual HIROC Private Client return per unit of risk taken on an apples-to-apples basis significantly outperforms the 60-40 comparative benchmark over a 4-year time frame. Now, this is the key to steady, less volatile portfolio swings, which help to elevate returns over longer periods of time. Our clients will receive a copy of this graph and the updated second quarter table for comparison purposes when they receive their quarterly reports over the next few days. And we remind everyone listening that historical returns are no guarantee of future returns, but at HIROC we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is very important that we review your wealth forecast on a regular basis with you so that we can ensure that your long-term goals are still in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. If you would like to review any aspect of your portfolio or wealth forecast, please do not hesitate to reach out to us. Now, the evolving inflation story is one of our key themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, inflation should be growing. But this does not necessarily appear to be the case. In the US, it is still well below the Fed's 2% target, inflation that is, and in Europe, well below the European Central Bank's 2% target, even though it's ticking a little bit higher more recently. Same thing in Canada, still lower inflation numbers, and interesting, we'll talk about that in just a moment. Japan, still low inflation, well below the 2% target. And although a lower pound in the UK due to the Brexit situation has caused inflation to spike, what does it all mean? Well, tomorrow it is widely expected that the Bank of Canada will raise rates by 0.25%, although I still have my doubts. And while there's been chatter about reversing the easy monetary policy stance in Europe and the UK, that may be farther out on the time spectrum. Nonetheless, without seeing any real inflation growth now or farther into the future, we do have to wonder what the central banks are seeing that we are not. Now, it could very well be that borrowing at low rates is causing asset prices to bubble up, and perhaps that is what they want to get in front of. And we'll see, certainly we'll see tomorrow what the Bank of Canada has to say when they make their announcement. Meanwhile, as we reach the end of the second quarter data, the U.S. GDP forecasts have continued to slip. As I have suggested many times on this call, when the yield curve gets to flat, usually a recession follows. Well, the Fed tightening and low long-term bond yields, if they remain that way, will certainly flatten the yield curve. And without inflation, longer-term bond yields will likely remain close to where they are, or perhaps even move lower. The difference now between the U.S. 2-year and 30-year bonds is about 1.5%, and in Canada, it's just a little over 1%. So we could see that yield curve in Canada flatten if the Bank of Canada starts to raise rates even further. But we're also paying close attention to the global debt situation and borrowers' ability to service that debt. When interest rates move a little higher, that will become a bigger issue. Global debt levels are growing at an approximate rate of 5% per year, while the global economy is only expected to grow at a rate of about 3% per year. And as we've mentioned, we think stocks, especially U.S. stocks, are expensive. If we look at the 12-month forward-looking price-to-earnings ratio at 17.3 times, and that includes expectations of about a 10% earnings growth for 2017. Well, the 10-year average is at 14 times. Now, just to get back to the average, earnings would have to grow by an additional technical situation here, sorry. The earnings would have to grow by an additional 20% in the next 12 months above the already expected 10% growth. This is not likely going to happen, so we are uncomfortable with the current valuations. If the U.S. economy can't grow more than 2%, it is hard to see earnings achieving even that 10% expectation. Another of our metrics of value, enterprise value to EBITDA, continues to show stocks to be as expensive as they were back at the time of the dot-com bubble. So high equity prices equates to high risk. We continue, therefore, to remain patient. Well, on the geopolitical front, the Trump administration is trying to move its agenda forward in order to provide more time to complete action on important legislative items and process nominees that have been stalled by a lack of cooperation. The Senate will delay the start of the August recess until the third week of August, and that came from Senate Majority Leader Mitch McConnell this afternoon. Lawmakers have an increasingly tight timeline to speed through a consolidated budget and appropriations process and raise the debt ceiling. Now, Treasury Secretary Steve Mnuchin said Sunday that the Trump administration still aims to pass tax reform legislation this year, and its focus is on cutting taxes for middle-class Americans and businesses, rather than the wealthy. Many analysts recently have predicted tax reform will be pushed back to early next year, and the extent of the cuts will be scaled back in light of the snarls in Congress. Well, Donald Trump Jr. acknowledged that he was told before a meeting last year with a Russian lawyer that she had potentially damaging information on Hillary Clinton that came from officials in Moscow as part of an effort to help his father's presidential campaign. And Prime Minister Justin Trudeau said the G20 serves an important role in pushing leaders to find solutions and prove they are listening to the concerns raised by protesters. He called the Hamburg summit a success, even though there were disagreements between 19 countries and the United States over trade and climate change. So here at High Rock, we want to continue to get portfolio growth, but we are also not comfortable taking equity market risk with the current situation concerning stock prices. The U.S. economic cycle is in its late stages, and there are signs that make us uncomfortable with having too much risk in our models and portfolios. We and our clients have worked too hard for our money, and we want to make sure that we invest it prudently. We are stewards of wealth. We are not gamblers. Paul, anything you'd like to add?
Sure. The only real change we had came on Friday and I suppose a bit yesterday. Our biggest energy equity weight in the tactical model, Trilogy Energy Corp, was taken out Friday by kind of a sister parent company, Paramount Energy. They do have cross ownership between the two companies, and I know both pretty well. So Paramount ended up buying Trilogy. Unfortunately, it was an all-stock deal, so they didn't pay cash for it. They just swapped shares on a certain ratio basis. And also, unfortunately, the price of oil on Friday, as people are probably aware, got absolutely hammered, hit down pretty hard, and that hurt the valuation of the Trilogy shares that we own that were being taken out. So most energy names in Canada were down between 5 and 8% on Friday alone. Our Trilogy stock for the most part of the day, and by the end of the day was pretty much unchanged or up 1%, so that was a bit of a win. Regardless, we did take the opportunity to sell out of our Trilogy shares on this takeout news at slightly higher prices, but unfortunately didn't quite work out the way I wanted it to work out. I thought they were going to do something different, but part of our thesis in investing in Trilogy was that Paramount was going to come in and do something like this, and again, it was just kind of bad timing on Friday with the price of oil. Good for the company, but not great for our investment. Nonetheless, it worked out okay. Anyway, that was kind of the only trade that we really the only transaction that we really had over the past week or so. That's it.
Paul, one thing that I think might be worth chatting about a little bit is the fact that our given what's going on in the world of central banks, more specifically in Canada, there was a fairly large sell-off towards the end of the quarter of our bonds, and we do have all our clients will own some bonds, but as a result, there was a bit of a markdown in bond prices, and we've sort of written about this, but I just thought maybe we'd chat about your thoughts there too, if you have anything to add.
Sure. I'm actually going to write a blog on some of that tomorrow, but and you stated it up front in the webinar here. Basically, there's been some concerted efforts by about 4 central banks, Canada being one of, Bank of England, ECB, and even the Fed, which has already been on a path, and you can see how much the Fed has raised short-term rates, Fed funds, over the past year and a half. it seems like some of these other central banks want to start. And to be honest, I think their motivation, and you talked about inflation, it's below everybody's target, and it's been that way for a long time and doesn't look like it's going up. It's really suspicious. I really think what they're doing is trying to take the wind out of the sails of the equity markets around the world, which are effectively, most of them at or near all-time highs. And you just think about this, and I'll show this tomorrow in one simple chart, but there's been out of the Fed, most certainly, there's been quantitative easing. They cut in short-term interest rate Fed funds right down to effectively zero. Government bonds rallied, and the leverage in the balance sheet, not leverage in the balance sheet, the Fed's balance sheet rallied all the way up from $800 billion to over $4 trillion. And the stock market followed all of that. Now, looks like it's being unwound. Fed funds have gone up from 25 basis points to 1.25, or 50 basis points to 1.25, I suppose. They're talking about unwinding that $4 trillion of balance sheet, and rates have already backed up. The last 4 days of the quarter of the month of June, rates backed up substantially in the U.S. They went from effectively a yield of 2.10 in the 10-year up to 2.35, or almost 2.40. And Canadian 10-years in effectively 5 trading sessions went from 1.40, yield to 1.40 up to they went up to 1.90. So like 45, 145 to 190, 45 basis points in 5 days. Those are big moves. So the bond market is sort of telling us, hey, these central banks look like they want to go the other way. Why is the question? I think it's to avoid any further bubble-like moves in risk assets, which one could read into being equities. So we did do a little bit of buying for clients. You suggested all of our clients own bonds, and you're talking government bonds, to be clear. We did buy some government bonds for some new clients. We didn't add any positions in government bonds as of yet to our existing positions, but there may come a time where we do. I'll leave it there. I talked for quite a while, unless you have anything else you want me to say.
No, but I think it's important, certainly for our clients, to know that even though the bond prices get marked lower, our view over the long term or longer term is that bond prices, even though they're marked lower, if inflation doesn't come back, as we don't suspect it will, and yet we still have short-term interest rates rising, that could actually put some upward pressure back on those bond prices as yields start to come down again, because inflation just isn't growing. So I think that's something that we're monitoring, but we do get knee-jerk reactions in markets from time to time, and it does impact over the short term. It does impact the valuations, and by virtue of that, your portfolio at quarter end probably took a little bit of a dip.
I would just add a couple things to that too, Scott. That's called mark to market, and that happens every night. Our portfolios get mark to market wherever a stock closed, wherever a bond closed, it gets marked. So there are day-to-day swings, and that's why we see our equity value in our portfolios go up or down. Yes, at the end of the quarter and the end of the month of June, our government bonds were hit a little bit, and our investment grade bonds were hit a little bit as well, because they trade with roughly an 85% correlation to government bonds. However, when people talk about bonds too, the only other thing to add is, and I think you sort of did, is it depends which bonds you own. And if we're right in our new thesis here, inflation does not materialize, this curve could flatten and go inverted very quickly, which means that shorter end bonds don't do very well, but the longer end bonds, 10-year and 30-year bonds, could do extremely well. So there may, as I said, there may come a point here where we may actually dip our toe in the water and add to our existing positions, because we're still underweight government bonds according to our models. So we think this might be a slightly better entry point than certainly the past few months.
Tremendous. Okay. Well, thanks for all that.
Thanks.
Anybody of our listeners who might have a question?
I have one. So what do you foresee happening if something happens to Donald Trump? And I don't mean just impeachment or something like that, but like what if he doesn't accomplish what he wants to do in terms of like middle class tax reform? What do you think will happen to the stock market?
Paul, do you want to take that one?
I could start with it and maybe you could add. I think the stock market does have a lot built into it, and if we go back and look at the equity market, it had a big rally up in early November upon his election, and to me, at that point in time, certainly the U.S. economy, if not the world, moved from what we were trading was deflation to sort of inflation. It was all about reflating the economy and through fiscal measures. And that sort of made sense to me going through November and December. And then I think what we saw, through January and February was the stock market took another leap higher. And I think that was, I think personally, it was a lot more retail money hopping in there because the ETFs exploded. And that's a good signal of retail money. So without the fiscal measures that, he has promised and that we think the market has baked in, I think it's natural to assume that the market would sell off to a certain degree, and most certainly not back down to where it was, and not from a fiscal perspective. That would have to be something else. But I think it's got a lot baked into it, so it would sell off to a certain degree.
It may not sell off enough to inspire those late buyers, the buyers that you're talking about that were buying in January and February. And as you said, individual investors tend to be sort of late to the game, and we are late in the cycle. So, but usually they'll have to suffer significantly before they start to bail out the other way. But in between, smarter money may be able to say, well, they're not going to get what they thought we're going to get. They're probably not going to be able to accomplish the higher economic output that they would hope to get. I mean, they've been talking about a 3% GDP growth, and it's really stalled out somewhere in the vicinity of 2%, and it doesn't seem to be going anywhere. And add to the fact that you do have things like situations like the Federal Reserve raising short-term interest rates, the yield curve flattening, that in fact could also, because debt levels are so high, that could very much start to pull the economy lower. And we know that stock markets don't go up in times of low economic growth, and even if we do get to recessionary situations. So anyway, we've talked a lot on this call, and I don't want to go into it anymore, but it is definitely worth considering, and I hope we answered your question.
Thank you.
All right. Well, we want to say thank you, everybody, for tuning in this week. We know that you all have busy schedules. If you do have questions, concerns that are not addressed here, or want us to talk about anything else in particular, please feel free to send us an email to do so. We will certainly be back with our next update on next Tuesday, but until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Bianca, we want to wish you all a great rest of the week.